Hello, welcome to chapter 4. In this chapter, we're going to be reviewing accounting. We're going to be talking about a lot of accounting sections, different parts of accounting, how accounting works with finance, right? There's no business like show business, but there are several businesses like accounting. David Letterman, every business has to have some accounting in it. That is why accounting is so versatile. When I did my undergraduate, I did accounting and finance. I double majored in both those because I liked finance so much. But I will say this accounting, you can always depend on accounting to get you some kind of job to get you in. Same with finance. Finance is always readily available. If you go in with an accounting degree, a finance degree, I'm telling you, the world opens up. Now, here's the thing, it's not as enjoyable as finance, I'll tell you that. And so that's why it is so sought after, and that is why employers seek it out. It is a very tough degree. A lot of tough degrees pay off very well. Some tough degrees don't, but I will tell you, in business, accounting, and finance pay off very well. So, what are our learning objectives in this chapter? We're going to explain how financial managers use three basic accounting statements. The three that we will be focusing on in this chapter are the income statement, the balance sheet, and the statement of cash flows. I will tell you more about it and why we're focusing on that as we go through. We're going to go detailed, discuss each one of these in detail, and show you how they relate to finance. We're going to discuss how depreciation affects cash flows and compute depreciation expense. So depreciation, if you're not familiar with it, depreciation is the allowable is what it does is it allows you to deduct an asset, like a big asset, something like equipment, a vehicle, something that is of great value, and to deduct that purchase over time. Why do we do that? Why do we allow ourselves to deduct this purchase over time? Well, here's the thing. If I buy a $50,000 vehicle for my company, is that vehicle going to be used up the day I buy it? Now, jokingly, yeah. I mean, when you buy a new vehicle, you drive it off the lot, it's not worth it. It's worth way less than what it was when you first purchased it, right? But not to the company, right? The value, the use of that vehicle is going to be expended over time. And because of that, we want to deduct that value over time. As the vehicle ages, as the vehicle gets used, it is worth less and less and less. And as we do that, we get to deduct that expense over time. This also helps us deduct as the vehicle produces more revenue, we get to deduct from that current revenue our current expense of that vehicle use. So it's kind of tying it up. As that vehicle is going to be used for 5 years, we get to deduct that vehicle over 5 years, right? And we get to deduct that expense of having the vehicle over 5 years. That also helps lower our income over that time period, right? And here's the thing, you may not have a lot of income at the beginning, but if you have this big deduction, maybe sometimes you can carry it over, but it's really not going to help your business till you start making that vehicle starts producing more income. And so this allows you to reduce the income as the vehicle is being expended out. Explain how the TCJA of 2017 affect the way corporations are taxed. This is where we get to tax. We're going to talk about how much interest expense is being taxed, right? So in 2017, that all changed, right? In 2017, it used to be that companies could expense all interest expense, and that was tax deductible. But now that is no longer the case, and we're going to talk about that. So here we can look at a quick income statement. Now we're not explaining it out. We'll talk about more in the coming slides, but here we can see how an income statement is broken down. So net sales are going to be all the revenue that we take in, all the cash that we bring into the company. Now, this does not say how much is cash, how much is accounts receivable or credit. So we're just going to say net sales, revenue, total revenue, right? The first thing we're going to do to deduct from those sales, that revenue, is cost of goods sold. Things that cost to make that product, right? Materials, um, labor, and things like that. That's cost of goods sold. That gives us our gross profit. So cost of goods sold are what it takes to actually make the product. Gross profit is what is left over after that. And then we have depreciation expense, right? So depreciation expense are things that we get to depreciate over time, right? So we may have bought that vehicle or this equipment or the building or anything that we're going to depreciate over time, we may have bought it years ago, but we're still expensing it out now. And so that's our depreciation expense, sales and administrative expenses. So these are things that are within that are built up to support. So like something like payroll, sales, advertising, right? These are all the things that help support the main process of the product, right? And that is what gives us that needs to be expensed separately away from our cost of goods sold. Then that gives us our operating income. From our operating income, we then get to expense out interest expense. So this is something you can do as a person, right? If you pay interest on a home, you get to expense that from you get to deduct that from your business, right? So if you have loans or if you have accrual things that you have to pay interest on, you get to deduct that interest expense from your profits. And then if we have income before taxes, then this is the amount that actually gets taxed. So this is why interest expenses and depreciation expense are important. They lower your income before taxes. So the smaller that number is, the less taxes you have to pay. So we have 5,490,000, and then that gives us our income taxes. 25% of that is our income taxes. Our net income. This is our profit. Okay. So we have our profit. This is what the company has made, our net income. After we deducted expenses, we've taken all our revenue, we've deducted our expenses, and now we have our net income. And our net income is 4,117,000. And then we have earnings per share, common stock dividends paid. So we decided we are going to pay out $400,000 in dividends. So change in retained earnings, this is the amount of number, the 3,717,000. That is the money that's going to go back into the business. That's the profit that we're going to put back into the business to go ahead and help the business run and to keep as capital. Now, that 400,000, that's the amount that we are going to share with our shareholders. We're going to go ahead and pay out a dividend. Now, there's 4 million over 4 million shareholders. So they're going to get, something, depending on how many shares they have. They have only one share, they're getting something like 10 cents or maybe even less than that. Right? But that's the amount we're going to share with our shareholders. They get a little piece of the pie. Now, financial statements, our annual reports include income statement. That's just what we looked at right now. Next thing we're going to talk about is the balance sheet. Then we're going to talk about the statement of cash flows. Income statement is important because accompanying notes. So accompanying notes are things that we need to note to people who are looking at our reports of anything that is particularly that sticks out or any important thing that's happened recently. So if we see something change really big in like the balance sheet, all of a sudden we take out, you see that your liabilities jumped up a huge amount of percentage, right? Well, we can say we opened up a new location and we had to finance a lot of the building, we had to finance a lot of the equipment. We can explain ourselves why major changes have happened or occurred, right? This is to let people that are investing in us, people that analyze our financials, to know this isn't an annual occurrence. This is something that doesn't happen all the time. This is a rare occurrence, and this is the reason why it's this way. Okay. So the firm's financial statement is our annual report includes income statement. Okay. Balance sheet, statement of cash flow, company notes. Okay. We already went. Balance sheet. So let's talk about the balance sheet. The balance sheet, we this is our accounting equation. Our balance sheet is assets equals liabilities plus owner's equity. So assets, what are assets? Assets are things that are going to produce revenue in the future. So everything that's an asset is something that's going to make money in the future. Liabilities, those are things that we owe, and owner's equity, those are things that we own, right? So everything that we have in our corporation or our business, we either own or we owe it. And all the things that we have in our corporation or business are things that are going to help us produce revenues in the future. So, what is an example of assets? We have current assets. Those are things that are liquid, right? Current assets. We can have these things, they're very accessible, right? Cash, You can't get more liquid than that. Inventory you can sell pretty quickly and it can be converted to cash. And accounts receivable, these are things that, these are IOUs that are given to you. Other things that we have are fixed assets, land, plant, equipment. These are things that are harder to sell and that are usually take time to acquire, or take time to dispose of, or to sell. And these are more long, they're for more of a long duration, right? Current assets, they revolve very quickly. Fixed assets take a long time to either replace or to acquire. Equipment, less accumulated depreciation, right? So these are things, equipment we depreciate over time. Liabilities. We also have liabilities broken up into current liabilities and long term liabilities. Current liabilities are anything under a year, and that would include accounts payable, accruals. Now, accruals are things that we acquire over time, kind of like accounts payable. Accounts payable is going to be more like things like acquiring materials, or more accounts payable, or like bills that are within 30 days. Accruals can be longer, but less than a year. And then we have debt, right? So we have T debt, ST debt. That's going to be just under a year. Uh, Long-term liabilities, or short-term debt, that's it, just anything under a year. That can be like a written note or something. Usually notes payable is what we're going for there, but usually notes payable can go for longer than a year. Short-term debt can be a note payable, but it's just like a 6-month payable, or maybe a long, or just under a year, right? Maybe a 9-term T bill or something. Um, Then we have long-term liabilities. These are anything over a year. So long-term bonds are at least a year, if not more. Most bonds go a year to 5 years. You can have some long-term bonds that go up to 10 years. Long-term bank debt, right? You take out a loan, a car loan. You take out a loan for acquiring equipment. You can take out a loan for anything, but anything over a year is going to be a long-term bank debt. Uh, Mortgages, right? That's long term. It's anywhere from 15 to 30 years. Even short-term mortgages are usually 15 years. You can go lower than that, but most businesses and people don't. And then preferred stock. Well, preferred stock is an infinite amount of time, right? So preferred stock never gets paid off. It's like a bond, it never goes away, but you never have to pay it back. You just pay the interest on it. So preferred stock, you are paying out a certain percentage of what they paid in. Give them an interest rate, or a percentage rate that you're going to pay off. And the preferred stock goes and does not have to be paid every time. But anytime a dividend is issued, you do have to pay out preferred stock owners first. Then you can pay common stock owners. Then owner's equity, common stock. So when people pay in, here's the thing: when you do get equity capital from equity, you get money from people that pay into the business, and they pay capital into the company. Uh, you don't have to pay that back. That's not debt equity, right? Capital equity is not debt equity, but you do take on more shareholders. You do take on more partners. Like I like to say, yes, you may not have to pay back the debt, but you do have to share your profits now with more people. Capital in excess of par. So par value is usually what you sell. The common stock would usually have a par value, and you can say it's a par value of $1, right? Anything over that is what you keep. So as the share price changes, you usually have a common par value, and then anything in capital in excess of that par, anything over that par value is going to be capital in excess of par value, and that also is owner's equity. Retained earnings, as we saw in the income statement, our retained earnings are everything that we keep, all the profits that we keep after we've already issued dividends and shared with stockholders. All that goes back into the company, and that is also the owner's equity. That is owned by the owners. So here's a balance sheet, and balance sheets are for a time period, for a certain date, not for a time period. So income statements are for periods of time. So an income statement can be a week, a month. Usually it is a month, a quarter, or a year. But it's just that time period. So if I did a month, I'm only going to be talking about the transactions and an income statement from January 1st to January 31st. Okay. A balance sheet just gives you a moment in time. At that date, on that date, December 31st, 2020, this is what we had in our accounts, right? This is what we had on December 31st, 2021. And this, the reason we do time periods and we do certain dates is so we can tell the difference, right? We can compare. Now, what's a certain date, but it's everything that happened up to that date. Unlike an income statement or a statement of cash flows, that is just a certain period of time from January 1st to January 31st. When I say December 31st, 2020, that's everything that's happened in the company, everything that we've done in the corporation up to December 31st, 2020. So cash is that it's in there on that date is everything we started the company till then, accounts receivable. So usually our balance sheet starts off with our assets on one end, and usually it's separated in two sections. So you have assets and then liabilities, and they're usually broken up in two sections so you can compare them because your assets need to match your liabilities and equity, right? So assets always equal liabilities and equity. Everything that you have in a company that's going to produce revenue is either owned or owed, right? So it's owed or owned by somebody in the company. And so if your assets don't match your liabilities and your equity, then there's some error in your processing here. So you got to make sure that both of these add up. And then here you can see and this is not broken down. Sometimes some of these balance sheets will be broken down into liabilities and equity, and that helps you. Well, this does, this is total liabilities here, but it's broken down in different sections so you can see it. But this, the reason for separating out liabilities and equity is you can see as we picked up more assets. Did that happen because we took out more loans or did we acquire and buy more things? Well, it looks like in this section, we totally either took on more common stock, right? And you can see we didn't take on too much. Yes, we did. So it looks like we sold a whole bunch of common stock, and that's why we have a lot more assets. And then we can also see retained earnings went up quite a bit. So we did take in a lot of profits, but not that much. So because we jump up from 46,000 to 54,000, so it's an 8,000 or 54 million, so $8 million change. And we can see, did we take on a lot of debt? Well, here we can see no. We actually went down in debt by $6 million, almost 7 million. But we did take on a whole bunch of new stockholders. Common stock, we did go up, but where we can really see it is capital in excess of par. So this may have been just common stock par value. We just took on another 1,117,000 shares that we sold, right? If it has a par value of $1, and then this is what's in excess. So everything that was paid over the par value. So this tells us that we've gone up in assets. We've taken on a lot more things. We have a lot more cash. We have, and we can see how much, cash went up. Our current assets went down. So marketable securities went down. Inventory, we must have, we went down in inventory. Uh, Fixed assets, we must have bought something, right? Uh, Less accumulated depreciation. So we must have made a big purchase. So that's why our assets went up. We did that through acquiring more capital through issuing more common stock. So this tells us how we've made changes in the company and how we did it. The income statement, let's go. We'll go over that real quick again. Cost of goods sold. So we have our income, right? So first thing we take in is revenue. Then we have our cost of goods sold, income. These are all expenses, cost of goods sold, salaries, depreciation expense, taxes, other expenses, interest paid, revenues, sales. Uh, you can also, here's the thing, companies can make revenue from quite a bit of different areas, right? You may be a company that sells, but then you also may provide services for people, right? So that can also be on in your sales, but you can also have investment income, right? Even banks have investments in the stock market. They have investments in money markets. They have investments in some currency markets. They have investments in other companies, right? A lot of firms have their own section that's just financing investments. So you can have investment income gains. So sometimes, right? Um, you may have a piece of equipment that you depreciate over time, and then you end up selling that equipment, or you end up selling something that you've purchased before, and it sells for more than what its current values is. So then you have a capital gain. So that's one way. Or if you sell an investment that you purchased and you made a profit, that's gains. Dividends received, those are different revenues. If you have investments, right? You can have dividends from those. We already talked about expenses, and then you take your revenues minus your expenses, and you get your net income, which is pretty much your profit. So net income, first you get your net income, your profits, everything that you've made after you have revenues and expenses. Then you can either issue dividends. So dividends come after that. You can share your profits with your investors and issue dividends, or you can keep it and put it all and cycle it back into the company to help the company grow, to make different purchases, to pay bills, to pay the daily expenses. You will, as a company, most of companies or corporations will have to keep retained earnings every year. That helps them, pay and keep the lights on, right? You need more, uh, you know, cash and liquid assets and current assets to keep the company going. So you may issue dividends, you may not issue dividends, but most of the time, if you have a profit, you will always have retained earnings. So now let's talk about the statement of cash flows. Why is the statement of cash flows important? Well, here's the thing. Cash is what keeps the company going, right? You can't pay your bills with inventory. You can't pay your employees with inventory or with building and equipment. You can have other assets, but cash is king. Cash helps you pay for things. It helps you keep the doors open. It helps you keep the company running. So you always, once you run out of cash, you start running into issues. You start running into problems. So companies need to make sure that they are having more inflow of cash than they have outflow of cash, right? You're trying to build up more current assets, more liquid assets to keep the company going. And you need to pay attention to that. If you have a bunch of cash leaving and not a lot of cash coming in, this could make for problems in the future. So, cash inflow, what can cause cash inflow? Well, from operations, you have cash sales, right? And that says cash sales, but it's more like, anything that you get paid for right then and there, right? Depreciation expense, that is a cash inflow, right? So, depreciation expense actually adds to the cash. Why? Here's the thing. Usually, when you make a big purchase with depreciation expense, right? You paid for the item, but you're not paying. You depreciate that. You take that expense off, right? You get to expense out that item over time, right? So, say I bought a $50,000 vehicle, and over 5 years, I'm going to depreciate that vehicle. So every year, I get to depreciate $10,000, right? That actually adds to my cash because that lowers my net income, but it doesn't lower the amount of cash I have. So I get to lower my income or my profits, but I get to add that amount back because I really didn't spend that $10,000. I really didn't have to pay that out. This is already for something I paid in the past. So depreciation expense adds cash inflow. Collections of accounts receivable. Anybody that owes you money, right, that has a balance with you, once they pay that off, as you receive that money to pay off they pay off that debt, then cash goes up. Decrease in inventory, right? So if I have a lot of inventory, what happens to make that inventory go down? You sold it, right? So if you sell something, that increases your cash. Cash outflow, payments to suppliers, right? Any kind of payment, any kind of expense, right? They have to pay. That's going to be cash going out. Salaries, that's going to be cash going out. Increase of accounts receivable. Like I said at the beginning, you had that number of sales or revenues. That doesn't mean that it's all cash. that they all paid us cash. We may have done some kind of credit with them. That could increase accounts receivable. That decreases our cash, right? If we increase accounts receivable, that means we're giving them product, but we're not receiving payment yet. So that increases account receivable as cash outflow. Decrease in payables, that means we're paying off our debts, but that means cash is leaving us and paying the person that we owe. And same with accruals, right? It's very similar with accruals. Now, statement of cash flows, cash inflows minus cash outflows equals our change in cash. So sales of fixed assets, right? We sell anything like a vehicle that we've had or anything like that, purchase of fixed assets, that's money coming out. So we sell something, that's money coming in. We're receiving cash, we're selling an item or an asset, right? Purchase of fixed assets, we're getting that asset in, but we're having to send cash out. Purchase of other firms, we're acquiring firms, right? We're acquiring new assets, new subsidiaries, but we have cash going out. And now it's from investing. Now, from financing, right? What when we finance something or do something like that, how do we get cash inflows? How do we get cash outflows? So, brings in more cash from financing? Sell of stock. If we sell more stock, we're issuing stock, issuing partnerships, we're issuing parts of our company to investors, but we are receiving cash to help ourselves grow and to help put money into capital into our company. Issue of long-term debt. Anytime we sign for long-term debt, we are receiving cash, but we are also, having to pay it back with interest later or notes payable. Anytime we issue debt, we are getting cash in and we're going to have to pay it back later. Cash outflow, buyback of stock. Companies have done this. Apple has done this. There was a big outrage with Apple by investors because Apple refused to pay dividends for a long time, and they've been sitting on cash for a very long time. So what did they do? They decided to buy back their stock. They didn't need as many investors. They decided, hey, we're going to make more of the uh, decisions ourselves, and we're going to bring more of the stock back in control of the company. We're going to repay long term debt, right? You got that money issued to you. You got to pay it back sometime, right? You pay dividends. That's going to send out money. Pay interest. Anytime you're paying out any thing for financing, so dividends or what you would pay out, sell a stock, right? So we got to pay our shareholders, and then pay interest. That's going to be interest that we've issued on debt. So here is a statement of cash flows. Let's look at it, right? So first thing we have is cash received from or used in operations. So net income, these are the profits that we've made from a certain time period. And this time period right here is going to be for the year ended in 2021. So we made 4 million depreciation. We get to add back depreciation because we deducted depreciation from our net income, but we really didn't pay out that 2 million. We just got to deduct it, right? So we get to add that back. Accounts receivable, so we can see that our cash went down, so we must have issued new accounts receivable. Inventory, right? So cash went up, so we must have sold a lot of inventory. Marketable securities, cash went up, so we must have sold marketable securities. Prepaid expenses, we had no change there. Accounts payable, so cash went down, we must have paid people that we owed. Accrued expenses, cash went down, we must have paid people that we owed. So total cash from operations, we now have 3,947,000. Cash received from use or from investments, new fixed asset purchase. So we purchased this new fixed asset. Cash went down $14 million. That's pretty bad. I mean, that's quite a bit of money, right? So if we take that, the difference, and we spent 14 million, but from our cash and operations, we brought in 947,000. We get 10,530,000. or 53,000. 10,053,000. So, now cash received used from financing activities. Proceeds from long-term debt issued, right? So we did issue some long-term debt, not as much from common stock. So if you saw on the balance sheet, we got a whole bunch from common stock. So we got a little bit over 4 million from long-term debt. We got a little bit over 11 million from common stock. We paid off some short term notes paid off, and then common stock dividends. We did issue $400,000. So that lowers the amount we received. So we got 12,053,000 from financing. We financed that in, all in. So that made our change in cash balance 2 million. So our beginning cash balance was 10 million, and then we went up to 12 million because we financed more than what that investment cost, and we made with financing and with our profits, we were able to bring in 2 million over what we had to pay in that total investment. So this lets us know that, hey, look, we're sitting pretty good. We got $12 million in cash. We can make some purchases. But we were sitting at 10. This helps us, raising capital helps us being able to make big purchases and not go totally, re- removing all of our capital. So we're still sitting with capital. It takes capital to run a business. You never know, when you're going to need that in the corporation or a business. So it's always good to have lots of cash and lots of capital, not too much, right? But and then also we don't want to be so much leverage. We'll talk about that later on how we build up our capital and what it consists of. Now, market value versus book value of an asset. Market value is what something is worth. So if I gave you something like a Pokemon card, right? And some of these cards can have a very high market value. People are willing to pay a lot of money for these cards, right? But the book value is just what you paid for it, right? So a book value, I could have bought a card packet. I don't know. I have no idea. I'm getting to the weeds of things I'm not too familiar with, but I'll go ahead and go into it. Say I paid $30 for a packet of Pokemon cards, right? And say there's 10 cards in there. So each card, my book value would be $3 per card because that's what I paid. I'm going to split the price evenly. I'm going to split the cost evenly, and I'm going to issue a $3 book value for each because that's what I paid for them, right? Now, the market value is going to be different than what the book value is, right? The way we do this in accounting is we do it with assets. So I buy a vehicle, my book value is going to be what I paid for that vehicle. So say I paid 50 grand for that vehicle. The market value may be higher or lower for that vehicle, right? Most of the time, it's going to be lower when it comes to assets that depreciate pretty fast. And this is why we add depreciation. But always they're going to be different, right? I say on my books that vehicle's worth 50 grand. Even when I put depreciation down and say that I'm depreciating $5,000 a year, that value is still maybe different with the market, right? I on my books, I say that vehicle to me is worth $45,000. But the market may say, no, it actually appreciated faster than that, and that vehicle's only worth 40,000, right? You're going to have a difference there of book value versus market value. But we always keep book value. We never change how much we pay for that car because that is what is going to be considered when we do sell that vehicle or we dispose of that vehicle. Changes in book value depreciation follow specific accounting rules, right? So the way we change the book value is we depreciate that vehicle or depreciate that asset. Here's one of the things that I need to let you know. When we depreciate these assets, and this is something you'll learn in accounting, if you've taken financial, if you've taken any kind of accounting, managerial doesn't talk about this is more financial, you'll know that you never change the initial purchase. You'll always have a separate account, right? That is a contra asset that keeps a balance of how much you've depreciated. You always take the initial purchase of that amount minus how much you've depreciated to get what your book value is. So factors that determine the disparity between market and book value. Time, right? So as time goes on, More time, more difference. As you use up an asset, right? My 2003 Toyota Tundra is worth way less now because of the 23 years that I've had it, right? So the 23 years over that 23-year period, time if on the book value has really lowered the value. That's it's worth nothing, right? It's worth scrap according to my book value. Now, here's a time where the market value may be more, right? Because of the cost difference and how much vehicles have gone up over time. Since my vehicle still works, it may be worth quite a bit of money over what the book value is worth because the market's willing to pay it because it's kind of expensive to get a truck now, right? And so anybody trying to get a vehicle that works and it's a full size truck, people are still willing to pay more money for that because they don't want to pay the high prices of a new vehicle. Inflation, right? Inflation, higher inflation, more difference, right? As inflation goes up, that can change your book value, can change your market value. We see prices in the market go up as inflation goes up. And so things that, were very that, were in lower in cost in the past may now have a higher cost because of inflation. Tangible versus intangible assets. Intangible assets, more difference. Intangible assets. An intangible asset is something like a patent or a copyright or something that tangible means something you can grasp, something that you can feel, right? So a vehicle, equipment, a building, that is a tangible asset. An intangible asset is something that you can't feel, that you can't grasp. A patent, we can build the product that the patent is, created, but the patent itself is an intangible asset, right? A copyright is an intangible asset, but uh, you know, intangible assets can grow over time. Assets usually depreciate over time. As with assets, the market value of liabilities may diverge from the book value, but the relationship is less complex. When we're talking about the value of versus book value of liabilities, the main factor determines the difference between market and book values for liabilities of the healthy firm is the time until a liability must be paid off. So, as we get closer to the time a liability, say that a liability isn't one that we paid off over time, but is one that has to be paid off all at once, but within a certain time period, like a bond, this can change how much the asset is worth. At maturity, the market value will equal the book value. So, as the time comes and when it's ready to be mature, the book value of the bond will its market value will be equal to the book value. Okay. So, market versus book value of equity. Total market value of equity is the market price per share times the number of shares outstanding, right? So, here's where we talk about equity. Some stocks can go well, most stocks are worth way more than what they're worth on the book, right? So, usually here's the thing, and companies want that to happen, right? If Apple so at the initial public offering, when Apple first sold their shares, right? They sold them at a low amount, a low number, right? But this was the money that the capital they needed to grow the company. And so on their book value, they may have received, let's say that they had a par value of $1 and they sold for $3. So they have a par value of $1. They sold, say they sold 1,000,000 shares, and then they got 2,000,000 shares in excess of par. But now we look at the market value, it's way higher, right? And it's these shares now may be worth $300 a piece, $400, 500. They can grow and grow over time. The book value of equity reflects the changes in other assets and liability accounts since it is account that can change to enforce the balance sheet identity. So the book value is what reflects as so let's read that again. The book value of equity reflects the changes in other assets, right? Really not the changes in assets of shares, right? Unless we sell new shares. That's when you will see the time value of market equity. When we see the shares outstanding, as we sell more shares, then we will see more of the change in market value. What the book value really reflects is the changes in other assets, right? Like liability accounts, since it is account that can be changed to enforce the balance sheet identity. These are things that are going to, with the market value of stocks, they can flow up and down. With debts or with liability accounts, those are going to change predictably over time and become either they over time they will become the market value will become the book value, because as we pay those off, we have to pay them out and what the market price of it is. Depreciation. Accounting depreciation is the allocation of an asset's initial cost over time, right? So if I bought a $50,000 car, I get to depreciate that. I get to deduct that expense over a time period. So say if I did it for 5 years, I would be able to deduct $10,000 of cost over each year of that vehicle. Allowable depreciation expense is determined by the established accounting rules. So these are not things we just make up. The reason I say 5 years or 7 years, usually your accountant, when you know this, or you can look it up when you make a purchase of a vehicle, the IRS will tell you how many years, depending on how much the asset is, what kind of asset it is, and how much the asset costs. It allows you to determine how many years you can break that into. And there's advanced depreciation, right? So you can do some, will let you do higher amounts like vehicles. They'll let you do higher amounts of depreciation in the beginning years and lower amounts of depreciation in the later years, because they know that vehicles depreciate faster when they're first purchased. And then they depreciate slower as time goes on. So depreciation basis, total amount to be depreciated over the accounting life of the asset, equal to the cost of the asset plus any setup and delivery cost incurred. So when you purchase a vehicle, sometimes they'll allow you to have the tax title and license being added to that vehicle, right? As a depreciation. Uh, and that's the depreciation basis. So this is what you have to take into occurrence when you're going to depreciate an asset. You have to take in all the things that everything that it takes to make that asset or set up. Say if it was a building, usually, or an equipment, you can deduct what the equipment cost, how much did it cost to set up the equipment, and how much did it cost to deliver the equipment. That is what you're going. That's the depreciable basis. This is the amount that you get to deduct over time. Straight line depreciation just takes it and divides it evenly, right? So that's like taking a $50,000 vehicle and dividing it over 10 years and dividing $5,000 equally each year, right? Uh, and then Mars modified accelerated cost recovery system. This is where I was talking about. This is a specified percent charged each year. So depending on what kind of asset it is and how much you paid for it, allows you to deduct certain amounts every year depending on that asset. So, like I said, like vehicles with marks, uh, it allows you to deduct vehicles heavily in the beginning years, in the first few years, and then lower that amount of percentage you get to deduct in the later years. So here's an example. Assume equipment purchase for $9,000 and the cost of delivery and installation was 1,000. So uh, you got a $10,000 depreciation. $10,000 is what the basis of how much we get to deduct. And we say the accounting life is 3 years. Depreciate over 4 years due to the half year convention. So we'll say because it's a $10,000 or it's $10,000, uh, so that half year convention, we're going to deduct for 4 years. Say you bought it later, like in the year, like, say you bought it in September or something like that. You have to deduct it now. You can't deduct that first year. You cannot deduct that full third percent, of it. You get to you'll have to do it over 4 years because it hasn't been enough. You have to have the product or the asset for over a year to be able to deduct that percentage that year. And so because of this, you have to have 4 years. Now, one of the things that it doesn't discuss here and it doesn't talk about is, and I'm going to let you know, is also with the basis, we usually take into effect and to calculate how much that product is going to be worth for scrap, or how much could you sell or dispose of that product or that asset over a time period. So even if that equipment is no longer useful, you give it a 10-year life, how much can you still make off that equipment after 10 years? How much can you receive for selling that equipment as scrap or for somebody else that can reuse it or something like that? That also has to take into consideration when you make up your basis for how much you can depreciate. So, first year one, $10,000, 33. Year two, 44. We get to $10,000 basis. And then year three, get to drop it off. And year four, 7.4. So it has a 3-year depreciation, but because of that, you had to go for 4 years because of when you purchased it. And then this allows you to say how much you can purchase. So usually this, because let's say because you purchased it late in the year, your first year and your first and second year are usually your higher depreciations. So usually this 7.4 got tacked on to this fourth year. And this, let's see if that's the same. 33.3 plus 7.4. Uh, so that 7.4 usually got tacked on because of when it got purchased or it got added to the last year, and that 33.3 is usually lower because of that. So because you purchase it later in the year, you can only deduct 33.3% instead of what it was supposed to be. And then that 44.5% you deduct in the second year, that's a full year. The third year, you have to lower it down 14.8%, and then the last year you added on that part that you took away. Now, if you get confused with this or if you're afraid how to do this, it usually tells you the rules, right? So if you ever have to deduct something yourself with your corporation or your business, the IRS will tell you what the schedule is. And it'll tell you, what kind of it you had. It'll find out what kind of equipment it is or what kind of asset it is. What kind of how much did it cost? And what bracket did you purchase it or the cost amount, and then that will tell you how many years you can deduct it for, and then it also tells you how much you can deduct it each year. So federal income tax, 21% flat federal rate on corporate income. Now, corporations used to be taxed like individuals. They used to have tax brackets, right? So the more you made as a corporation, the more you would pay out. That got changed to a 21% flat rate. Prior to 2018, there was a progressive federal tax system on corporate income tax rates as low as 15% and as high as 38%. So they were like, if you've ever done your own taxes, if you ever filled out your own income tax, we are on a progressive system, right? The more money you make, the higher marginally higher you pay in income taxes, right? So you are charged a certain amount, like start off at a lower amount, start off a lower percentage of tax with your lower pay, and then as you make more and more money, your taxes are marginally increases as you go. That's used to be what federal income tax or for corporations that used to be it. Now, since 2018, they play a flat rate. Now, also they changed was interest. Interest paid on corporate debt is no longer a tax deductible expense for many businesses. And it is for a lot of other businesses, right? But not like corporations like Walmart, any huge corporation that we know of, Target. This is also a change that occurred because, we do a flat tax rate. We want to still take in money. What's one of the ways that we can still get higher taxes? We take out how much they can deduct for interest. Interest expense above 30% of adjusted taxable income is not deductible. Adjusted taxable income equals taxable income plus depreciation plus amortization plus depletion. So you get to add all this up, right? You take 30%, and that's where you stop. Now, does it mean they don't get to deduct any interest paid? No. Only the 30% up to 30% of this adjusted taxable income can they deduct, right? Now, here's the kicker. Businesses with gross receipts of 25 million or less may continue to deduct their interest expense. So, you have to be a corporation that makes more than 25 million. Now, you would say, "Well, that's not there's this to protect the small mom and pop shops, right? All small businesses, smaller businesses will probably fall under that 25 million so they can still deduct all their interest paid. Where this is really going to take into effect is big corporations, right? Any corporation that I know of, any chain, anything like that, usually is making more than 25 million, and they will be the ones that are having to pay these higher tax rates because they were not going to be able to deduct as much as interest. Now, this also helps. This also, you know, helps businesses or kind of guides businesses away from taking out a lot of debt. Because where do you pay interest? Interest is paid on debt, right? So any kind of liability where we do debt financing. So dividends are paid to common and preferred stockholders is not tax deductible. So dividends, we always here's the thing when you take this is why we say double taxations, right? Uh, when we say double taxations with corporations, because you have to pay taxes, right? If we saw there on the income statement, we have income before taxes, right? Interest and tax. So then we have interest and then tax. Still have to pay out those taxes, and then we have our net income, right? From that is then paid to the shareholders, right? So that money has already been paid tax, and when you pay your dividends to your shareholders, then they have to pay capital gains tax on that as well. So that's where we always say that corporations are double taxed, right? Double taxation. Dividends received by a corporation from another corporation have at least a 50% exclusion from taxable income. So this is where it goes differently. If I'm a corporation and I pay a dividend to another corporation, they get to at least have a 50% exclusion, right? That they do not have to pay taxes on. So dividend income, Corp B owns 100 shares of common stock in Corp A. Corp A pays a $2 share dividend to its shareholders. So Corp B has 100, so now it's going to pay them a $200 dividend. 50% of the $100 is taxable. 50% of the $100, 50% or $100 is tax free. B Corp pays an effective rate of 10.5% on $200 of dividend income. So that's how that works. If a corporation pays a dividend to another, they can at least exclude 50%. So 50% of that dividend, they do not have to pay taxes on. 50% they do have to pay taxes on. At least. So it could be higher than that. Uh, 100% taxable income at 21%. Federal taxes, 21%, $21 at 200. So here's the thing. Capital gains tax, right, or the corporation has a flat tax of 21%. So they don't if they had to pay taxes on that whole 200, it'd be $21. But since they only have to pay 50% of that tax, they only have a 10.5% tax rate. Hopefully, this helps you out with this chapter. If you have any other questions, any other concerns, let me know. I will try to have some other things up for you that help you with this chapter. If you'd like to discuss anything further, please let me know. I'm readily available. Just send me an email or call my office, and I'll get back to you.